I wanted to put this together for you to address your concern about projected collateral exposure, which really talks to the relationship between the cost of borrowing the funds and the potential crediting of the policy, and your comment about the market doesn't typically do 6.8%. This is from Chatham Financial, chathamfinancial.com. You can go and check it out yourself. I can send you the link as well in this video. But this is the historical LIBOR and SOFR. So prior to 2023, banks were using LIBOR as the benchmark. And then when the LIBOR went away, they flipped over to SOFR. And this is kind of showing you what the rates have been since 2001 through the end of 2024, and then moving forward to the forward curve projection thereafter. So the SOFR rates or the LIBOR rates that were back in 2003 and 4 hit a bottom. Rates were at 1%. Banks were putting a spread on top of that. That's when we were borrowing money around 2.5, 2.7% all in. So you can add an extra 1.5 to 1.72% on top of these numbers just to keep it, pretty apropos to how we were borrowing the money. And so at the bottom, in 2003, 2004, and remember that started the lost decade between 2000 and 2009, which I'll show you here in a second. We were borrowing money, like I said, around 2.73%. Rates went up in 2005, 2006. Came down again, hit a very good low that we took full advantage of in 08, 09. That was the mortgage lending crisis where the Fed drops rates all the way down. And we experienced borrowing money in, the 3% range, sub 3% range for quite some time. And then 15, 16, 17 rates went up again. We were probably borrowing money at around 4.5%, 5%. Dropped again in 2020 due to COVID and the pandemic, again borrowing money around 2.5, 2.7%. And then the drastic increase from 21 to 22 where we were borrowing money at 7.5%. And today we're borrowing money at, that 5.8, 5.7, 5.9% range. So those are the historical credits or the historical lending rates. This is from the John Hancock policy. I want to focus on this high capped indexed strategy. Although we'll probably end up putting you the enhanced high cap to under promise and over deliver, this high cap strategy has a 12% cap, but a guaranteed 30% multiplied, which really means the cap is 15.6%. So in 2004, it would have credited, or it did credit 7.5, 15.6, 3.8, 0, 15, 14, 0, 15, 15, 15. You can see the crediting that this happened during that period of time. I have a little calculator that I can use. And so from 2004, the end of 2004 to the end of, I can only go back to 2023 right now. I can't go back to the end of 2024. Using the same S&P index at a 15.6% cap, the actual return of the stock market with all of the good, all of the negative was 7.55% during that period of time. But because your policy and these types of policies have that guaranteed 0% floor and the cap of 15.6, the actual return of the policy during that same 20-year window is 9.08% during that period of time. And you can see actual return, all of the good, 29, 28%. And then the limited returns is the indexed universal life policy with the 0% floor in those negative years and the cap of 15.6. So not all of the good, it hits a ceiling at 15.6. But when you average that out over that same period of time, it's a 9.08% actual return compared to a 7.55% annual return. And so, yes, in some years, we may experience a negative arbitrage where we hit a 0% floor and we're borrowing money at whatever that current lending rate is at that time. When you take these numbers and you line them up side by side, we're averaging about a 6% arbitrage or higher the difference between the cost of borrowing money and the crediting of the policy, greater than a 6% arbitrage on average. In the illustration that we sent you, we're only illustrating a 2.3% average arbitrage. So we're actually, in actual performance, performing 3 times better in arbitrage than what our illustration showed you. So while I understand the concern of what's the potential worst case scenario, I mean, we can paint any Armageddon scenario of zeros happening in the market for an extended period of time. But the reality is, even when we go back to the worst possible window that we've experienced in our adult lifetimes, the lost decade of 2000 to 2009, where the market actually had a negative 2% return, we would have experienced a 5.8%, much lower average borrowing rates than where we're borrowing the money right now on average. So that's something to consider when you're proposing what's the worst case scenario. We need to take the historical actual performance and the actual relationship between borrowing rates and crediting rates of the policy. And I hope this brings that to light for you, that we are much higher than the 6.8% return. I'll go back to it. 2004 through the end of 2023, that 20-year window, that average is 9.08%. And the cost of borrowing the funds was probably at an average of around 4 to 4.5%. Take this in mind. Let's keep this conversation moving, but let's focus on how the relationship actually occurs as opposed to Armageddon scenarios, which have not happened. Hope this is helpful.